just keeping in mind that this is not, bank regulation is not going away, and managing the bank in a safe and sound manner is always going to be important. And maintaining relationships with the regulators is also equally important.
And welcome to another episode of Banking Matters. I'm your host, Linsey Hugueley, and joining me today is Bruce Toppin. Bruce is a partner in the financial services and capital markets industry group at Hush Blackwell. Clients rely on Bruce's guidance and experience on a wide array of matters such as mergers, acquisitions, business expansions, debt and equity security offerings, and complex financing transactions. With nearly 2 decades of experience, Bruce also brings extensive knowledge of federal and state banking laws and regulations, assisting clients with regulatory applications, examinations, formal and informal enforcement actions, and regulatory compliance matters. In addition, Bruce also serves as the first point of contact for his clients who may not have in-house legal resources for corporate governance, capital and strategic planning, contract negotiation, cybersecurity, and data privacy. He also frequently advises and assists investor groups in connection with platform acquisitions, as well as board of director, management teams, and shareholders on matters involving fiduciary duties, ownership succession, executive compensation, and director and officer liability issues. Welcome, Bruce.
Thank you for having me.
Yes, I'm so excited about our conversation today. I know it's going to be so relevant for all of our listeners. But first, here at Banking Matters, we always like to hear how you got your start in working with financial institutions.
Sure. So my story I got into it in a roundabout way. Out of college, actually in college for a little bit, and out of college, I worked for banks, and before law school, primarily was working for a large money center bank in their kind of workout division. And I didn't really love doing that. So I went to law school thinking I wanted to be a litigator, and just by chance stumbled into an internship after my second year of law school, working for a boutique banking law firm here in San Antonio that did basically the type of work that I do now, and just kind of fell in love with it. It's a really enjoyable practice, largely because of the people that I get to work with on a regular basis. And so kind of changed career paths and decided being a litigator wasn't really as exciting as I thought it was going to be. And I've been doing this ever since.
Yeah, it's so funny how many people just kind of happenstance into banking, but once you're in it, and sometimes you try to resist it, it's like you can't not be in it, because it is so easy to fall in love with the people that you work with. I thought I was going to be a certified public accountant, and I worked at a firm for 3 entire months after graduation, and I said, I want to go back to banking immediately. So today we're going to dig into some regulatory conversations. The topic is kind of the climate of how things are. And so at the beginning of 25, the Trump administration and the federal banking agencies, they've kind of appeared to prioritize reducing the regulatory burden on banks, especially community banks. So, and they're trying to take a lighter touch in the supervisory process. Can you talk about some of those changes that we have seen?
Sure. So it's really been, I would say, starting early last year, just a steady stream of either from the administration itself with some of the executive orders, but then really from there, the federal banking agencies have really jumped on board with the idea of lightening the regulatory burden on banks, making the supervisory process easier or less painful, depending on kind of how you want to your take on that, but at least less burdensome. And the OCC has really, and the FDIC, I say in particular, those two agencies have really issued a lot of pronouncements that are aimed at achieving those objectives, and the Federal Reserve as well. I think we've heard a lot of talk from the Federal Reserve, in particular. Mickey Bowman, I think, has really championed this cause They just have been a little bit slower to act, which I think is sort of kind of typical of the banking agencies that we've seen. In terms of, just sort of like going through the timeline, last year, kind of late last year, the FDIC came out and said, in testimony about all the changes that they were going to make. They were scaling back a lot of the regulations that had gone into place. The OCC also issued some pronouncements back then, in particular with the OCC and national banks, beginning at the beginning of this year. They really have worked towards eliminating policy-based exam requirements that are not mandated by law. So over the years, the agencies and the OCC in particular, in this case, had evolved their exam activities to cover more than just what was required under the various laws applicable to banks. And so the OCC undertook an action to scale that back to limiting it to, this is what the law says that we as the regulators of national banks have to do, and this is what we're going to do. And so examples are like the National Flood Insurance Program, fair lending assessments, CRA performance evaluations, and another number of other areas of examination are generally being extended out to longer periods rather than kind of what the cycle had been under previous administration and for previous years. There's also been a focus to really try to tailor the exam frequency as this relates to community banks, based on the bank's size and complexity and risk profile. That's obviously something that the agencies talk a lot about in the context of risk management. I think they're also trying to apply a little bit of their own guidance in how they evaluate really how much of a supervisory role they need to take in working with banks that they supervise. I'd say one example of that is that the OCC has customized its supervision relating to model risk management for community banks. So, for example, this would include not requiring annual model validation under appropriate circumstances. So just things that are not necessarily earth-shattering or just going to completely change the organization, but aimed at trying to make things a little bit easier to operate your bank and have to spend less time on sort of the regulatory and supervisory burden. I'd also say one other sort of really important, and I think kind of somewhat overlooked announcement was that late last year, I think it was in November, the Federal Reserve published some internal guidance that they had issued. I think the internal guidance went out in October, came out in November. Vice Chair Mickey Bowman published this and made it available to everybody to see sort of what they were planning on doing in terms of focusing their supervisory activities on, what she referred to as material financial risks that are applicable to banks, rather than what I think you'd largely seen over kind of building over a number of years was bank regulators were really getting bogged down on processes, policies and procedures. Everything has to be documented. And if it's not documented, then it doesn't exist. And those concepts are important. But at the end of the day, how the risk management profile of the bank and how that risk is managed by the bank and its management and board of directors, and not losing sight of really focusing on that as the key priority is really what this guidance was intended to focus on. One thing I think was sort of encouraging for banks was they're trying to maybe curtail or scale back a little bit of the use of MRAs or MRIAs and other sort of enforcement techniques to where they are deemed as being absolutely necessary. And then also creating the ability where there are enforcement provisions in place in an enforcement action, which typically they'll cover, 4 or 5 or multiple areas of remediation, instead of like keeping that enforcement action outstanding for however long it takes to resolve all of the issues. they've said, look, once you clear an issue, we'll pull that out of the enforcement action, and we'll just kind of focus on what's left. So just trying to make it easier on banks to comply with the enforcement actions that they do find themselves under from time to time.
Absolutely. And I know that I've experienced this with the community banks that I work with. Like one bank received an MRA under BSA um, not having strictly for not having the capable, what was it? They said that we weren't reviewing transactions deep enough and CTRs deep enough to make sure that we were looking at structuring. Whereas this bank is one branch, they're $130 million. We see all of the transactions, our BSA officer reviews certain things, and to escalate it to an MRA, it was just really shocking.
Mhm.
Whereas that could have been a conversation, whereas maybe we just needed to tighten up so that we could, like you said, show proof that we were looking at those specific things. That was probably the most over the top that we've experienced so far as like MRA. Everything else you could kind of justify, but that one, it was just very shocking.
Yeah, and I think the OCC's tried to kind of focus on that as well, particularly with respect to BSA, AML compliance. They issued some guidance back late last year, intending to kind of allow examiners some discretion to kind of go take a little bit lighter touch on community banks. So, like the BSA AML exam manual that applies to all banks of all sizes is very broad, and it really is designed to capture everything that you would see like in a large money center bank, and then like banks like the one that you were describing, largely a lot of the stuff that's in there they're looking at is like, these things don't happen at our bank, for one, and two, like we don't have the resources to commit to do all of these things. And so allowing examiners to kind of use a little bit more discretion, like, okay, this is a small community bank, how much of these issues are they really dealing with? And so allowing them a little bit of discretion there, I think I think we're starting to see that. But like I said, that was something that the OCC focused on late last year as well.
Yeah, we're it's just been a lot in conversation of how it is kind of a more hopeful outlook to where it does feel more like that the things that are being looked at by the agencies are actual, like you said, material issues, because we have beat the drum to death of policies, procedures, show your work. Do you have proof that you're doing that? How are we validating that? Which we monitor all of this in our monthly compliance meetings, and we're talking about it, and we have a yearly schedule. But at the end of the day, sometimes it feels like, what more do you want?
Yeah, and this is a process that's going to take time too. I think that the administration and the agencies have really focused on this as a high priority. But I mean, as any banker and people in my profession will say, like, there's just layers upon layers upon layers of regulation, a lot of which probably doesn't need to be either interpreted as strictly as it has been or enforced as strictly as it has been. And so I think a lot of this is just going to take time.
Yeah.
I know, I mean, I was preparing for this call and I got a bulletin from the OCC that they issued two rules just this morning, about 15 minutes ago. One dealing on fair housing home loan data system regulation, on data collection requirements, and then the other on easing the licensing requirements for community banks for certain corporate activities. So it's going to be an ongoing process that I think that we'll see, certainly for the rest of this year and into next year and possibly the year after that. But it definitely seems to be moving in the right direction.
Absolutely. And so, speaking of the OCC, last month they issued proposed rulemaking to revamp the appeals process for material supervisory determination. So, what sort of change are they actually proposing, and why?
Sure. So the all of the agencies were required under previous law to develop this appeals process that dates back to 1994 under the Regal Community Development and Regulatory Improvement Act. And so the OCC had developed its appeals process that was largely not being utilized. I was reading in some of the materials, I think it was in the regulation, they said that I think it was last year, maybe the year before, they had, there were 1,100 or so enforcement actions or material supervisory determinations, and there were only like 11 appeals. And I think they recognize like the process that we have where it would go through it would go through the ombudsman was not really viewed as like a true independent process. Mm-hmm. And I think there was some concern on the part of banks that if we do go through the appeals process, is this going to come back? And then the examiners are going to be harder on us next time. They're going to get bent out of shape about this. So the OCC has wanted to kind of create a more independence, or at least make it clear that the process is independent, but then also to specifically say, like, we're prohibiting examiners from retaliating in the event that you go through the appeals process. So they've more formalized it to this de novo review standard of appeal. So we'll see how that plays out. I think it'll certainly be helpful. To what extent, I don't know. I think, one, we're seeing less of these issues come up. So there's probably not going to be that many opportunities for appeal as maybe, in prior years. But I would think that it would have some sort of helpful impact on banks that feel like, hey, look, like we've been wronged here and we need an opportunity to be heard. And so I think this will help with that.
Absolutely. And so what are you seeing as far as current trends for the criticisms that banks are receiving during examinations or even informal and formal enforcement actions?
So overall, enforcement actions, I think not surprisingly, have gone down in terms of the number of like severe enforcement actions. In 2024, I think there were about 75 severe enforcement actions against U.S. banks. That number dropped down to 23 last year, and only one of those was in Texas. So a big drop in terms of just the number of enforcement actions, which is obviously encouraging. I think correspondingly, we've also seen a big increase in the number of terminations of outstanding severe enforcement actions over the same time. So historically, over like the last 5 years, I think there was like on average around 30 or so terminations of severe enforcement actions. Last year alone, there were 62. So I think the agencies are trying to clear out existing enforcement actions to the extent that they can. So I would expect that trend to continue, fewer coming in and more terminations of existing enforcement actions. In terms of what we're seeing now as either focuses on during the course of exams or when we are seeing enforcement actions, they've shifted from like commercial real estate was a big concern a couple of years ago with interest rates jumping up unexpectedly. That has really trailed off quite a bit. And now BSA is still a big one that hasn't changed. I think that like looking at some of the bigger banks that have had some BSA issues, I think TD Bank is really sort of the poster child for how not to run your BSA program. And so some of those, I think we're going to continue to see with BSA. I know the criticisms tend to be, particularly with some of the smaller banks, is weak customer due diligence programs or failure to adhere to the program that you have. Shortages in personnel or lack of training or just lack of resources, a lack of oversight, governance, and accountability. And then I think you mentioned like the deficient suspicious activity reporting. That's always kind of a issue that the banks deal with to one degree or another. Other areas where we've seen some enforcement actions, I think cybersecurity has kind of ticked up a little bit and probably will continue to be a major focus. with banks of all sizes, but community banks in particular, a lot of times you'll see criticisms of inadequate training of personnel. Social engineering is obviously a big risk that banks and all other companies face. Not having a robust training program, like continuous training program on this is what social engineering looks like, and these are the other various cybersecurity threats that are out there. Another one that we've seen is outdated encryption protocols, failure to restrict outbound ports on machines so that people can just plug in a flash drive and download whatever they want, and things like that. So that's going to be an ongoing area of concern for regulators, I think. And then sort of also in that same vein is just overall IT governance. The information technology is obviously going to be a huge issue for banks in years to come. And so there we've seen a lot of concerns or criticism on lack of segregation between the CTO and ISO duties. End of life monitoring, planning, and transition seems to come up fairly frequently as these technologies evolve. And I know some of the core processors are moving off of some of the older systems into newer systems, and banks being able to stay ahead of that and recognizing that this is a major risk is something that we see kind of pop up from time to time. Vulnerability assessments, and then one thing we're starting to see more of recently is as the use of AI has really proliferated outside of just the financial services industry, but even with respect to financial services, all vendors are claiming to use AI to one degree or another, and some do and some don't. And understanding sort of the AI component to whatever it is that the technology is that you're utilizing, and having an understanding of kind of what the resources is meant to do, how it's meant to help you in your organization, but also understanding the vulnerabilities of AI, and then having and developing and implementing appropriate policies and procedures and risk assessments to make sure that, okay, if we're relying on artificial intelligence for whatever functions that we operate under, are we able to validate that the outputs that we're getting are accurate and appropriate, and are they going to be useful in our business as well? I know one example that we've seen, and I think probably is one of the more common ones, is use of AI in loan underwriting. And is that going to create fair lending risks, unintended and maybe unknown fair lending risks, because you're farming out some level of this underwriting to something that's outside of kind of the human purview. And so making sure that you're not exposing yourself to those types of risks is an issue that I think that banks are going to see kind of going down the road.
Absolutely. And so, do you think that there's one or two major areas that banks may face those supervisory issues moving forward, like future thinking?
I like I said, the cybersecurity is a big deal. I think, with what's been going on overseas in Iran right now, you're starting to see more activity in terms of sort of the Iran-backed bad actors are starting to get a little bit more active. There's likely going to be some impact in the financial services industry there. Probably, almost certainly that's going to impact larger banks and to a much lesser extent, community banks, but something that the banks need to be cognizant of. I know that regulators are also kind of flagging that for banks. And then the evolution of stablecoin and how that's going to impact the financial services industry. I think we're really, really early on in that process. We saw the Genius Act pass last summer that really kind of set the framework for, okay, banks are going to be able to operate in this space. And it created the ability to create a more transparent framework and one where that needs to be regulated. I think that the challenges there are that it's just so quickly evolving. There's lots of players in that industry. Most of them have historically been offshore. And so bringing that to kind of a domestic level is going to be helpful, but it's just going to take some time. The agencies have started to, OCC just issued some proposed regulations under the Genius Act. I think it was last week. So we'll kind of see how that evolves. But I think from a broader perspective, you're seeing banks recognizing that this is a potentially substantial risk to their business model. There's already been pretty substantial outflows of deposits into stablecoin over the last year or two. Depending on who you talk to, I mean, some people more on the technology and stablecoin advocacy side are saying that it's just going to be like there's no point in people having bank deposits anymore. I don't think we're going to get to that point, but it's definitely going to have an impact on banks from a liquidity standpoint. I think I've heard it likened to the sort of the disintermediation that occurred back in the 70s and 80s as a result of the kind of the advent of money market mutual funds, where all of a sudden there was this other opportunity for depositors and a lot of money flowed out of banks. Well, they've evolved and everybody has managed to coexist in that space. I think we're going to see something similar with stablecoin, but there's going to be a lot of bumps in the road, I think, before we can kind of get to a real stablecoin environment.
Absolutely. And so, Bruce, here at Banking Matters, we do also like to wrap up with one piece of advice that you would like to leave our listeners.
I would say that despite an overall trend towards more friendly regulation and supervision, I think the important thing to keep in mind is, one, don't get lackadaisical about the risk management and the things that you need to be doing within the bank. And I think it's also important to keep in mind that this is sort of, as we've seen over the last several years, regulation of the financial service industry ebbs and flows with whoever's in the White House, right? And so we went from a relatively relaxed regulatory environment under the first Trump administration to a highly regulated environment under the Biden administration. And then the pendulum has swung a large, degree in the opposite direction, but it may swing in the other direction in the not too distant future. So just keeping in mind that this is not, bank regulation is not going away, and managing the bank in a safe and sound manner is always going to be important. And maintaining relationships with the regulators is also equally important. So those are maybe some tips I would offer.
Absolutely. Well, thank you, Bruce. And for the rest of our listeners, that's Banking Matters.